From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, Treasury yields breaking out to new highs as economists start raising growth forecasts. Investors continue piling in to credit markets. We begin with the big issue, tension building in the bond market.
There's something cooking under the surface.
You have a tug-of-war going on.
The 10-year Treasury is rising.
We have negative real rates.
Inflation looking forward, growth looking forward.
Rising inflation expectations.
Increased growth expectations.
We've used a tremendous amount of debt to kind of get here.
Signs of excesses in the market.
The markets has been flooded by liquidity.
That is going to act as kind of a noose around the economy's neck.
Liquidity risk is the thing you've got to look at.
So much cash looking for a home.
You do have an asset shortage.
A supply-demand mismatch in that front-end sector.
And it's really pushing the yield down.
But cash is everywhere.
Too much cash.
The negative real yields are telling you that there's weakness out there.
There's a bunch of things that are red flags to me.
Joining us now is SocGen's Subadra, Rajappa, JPMorgan's Bob Michele, and Troy Gayeski of SkyBridge. Subadra, let's start with you, and we'll start at the long end, and then we'll work our way towards what's happening at the front end of the yield curve. On the long end, Subadra, 10s, 30s, just how self-limiting do you think this sell-off might be?
So that's a very good question. I mean, if you look at 10-year yields are quite rich relative to fundamentals, right? And they've been low, given the fact that you've had we're in the middle of a pandemic, the Fed's buying assets. And now what you're starting to see is a repricing higher in yields based on a variety of factors, including inflation, as well as the fundamental drive and improving economic fundamentals, as well as infection rates improving. So the question really is, where do we go from here? And that, to me, really depends on the feedback loop from risky assets. I think if risky assets hold up, and today is a very good example of that, where you're seeing that Treasury yields are high, remaining high, and risky assets are still holding up quite well and rising. So that to me is a sign that there's probably a little bit more momentum for yields to rise from here on. But it's also interesting that in the Treasury world, if you look at real yields are rising, and inflation expectations are actually declining. So that, again, might be something that to keep in mind that might actually stymie this sell-off. So we'll just have to see how things progress from here on.
Bob, build on that if you can. We've got a 10-year yield up 5 basis points right now at 134, a 30-year yield up 5 to about 2.13%. The limits of this sell-off, the limits of this move, what are they, Bob?
Well, I should say longer term, I expect the 10-year, the right place for it to be is 160 to 190. I think we're headed there for the back half of the year. There's a lot of growth and inflation in the pipeline, a lot of fiscal and monetary stimulus, and that's what the market's locked onto. Next week will be very important. We have Powell, we have Clarida, we have Brainerd. They're going to be out talking. I think they'll try to stop this thing in its tracks. We've gone a long way, a little too quickly for them. We need to get through the rest of the winter and the spring, and then I think they'll let yields go a bit higher.
Troy, do you agree with that? Do you think they're a little bit uncomfortable, or will be a little bit uncomfortable with what's playing out on the screen this morning and through the afternoon?
Yeah, well, remember, on the one hand, they have a big smile on their face, right? Because central banks like steep yield curves. It shows that their inflation campaign is working extremely well. But on the other hand, they have a frown, right? Because a key part of this story, at least for the U.S. consumer, has been a very robust housing market, not only in terms of contributing to GDP, but also in terms of inflating home prices. And so, you push the 10-year up 30, 40, 50 more basis points from here, and you're not only going to slow home price appreciation, which obviously has the most powerful wealth of still, but you're going to reduce new construction, which has been a real key driver of the economy so far. So, I think it's more glass half full right now than glass half empty. But they're certainly watching those factors very closely.
This idea they step back in, though, Bob, how so? Verbally or with action? What do you think they tee up?
Well, I think they tee up quite a number of things. I think they talk about their long-term inflation target. They're still a long way from it on a sustainable basis. I think they expect that over the short term, you could see a spike, but they're willing for that to be transitory. I think their comments in the last FOMC minutes, they talked about their maximum employment target being broad and inclusive. What does that mean? Does that mean when we got to 3.5% unemployment, but wage gains were suboptimal and people fell out of the recovery, that the right level for unemployment should have been 1% to 2%? I think the Fed has a lot of scope to manage the market back down a bit here.
Subadra, picture this. We're at the back end of this year and we're looking at GDP north of 6%, unemployment south of 5%, CPI north of 2%. Can they stick with this idea that they stick this out? They just sit out the whole thing and don't do anything?
I think that that's really the tough question, because what really, the Fed's reaction function right now is based very much on benign inflation and very, very slow progress on the employment front. If we do start making progress, it's kind of like, be careful what you wish for, if you will. If Treasury yields, start rising too fast and the economy starts to overheat, then the Fed is going to have to react. The question is, what do they do then? Do they taper asset purchases? In which case, I think yields will rise even further.
Yep.
Can they raise rates? Will the market, I think, certainly would start pricing in hikes sooner than people expect.
Got this really strange dynamic playing out at the front end of the yield curve as well, Troy. I'd love your view on that. At the long end, the story's obvious. We've talked about it for weeks now. At the front end, we're seeing a lot of demand and not enough supply. A real shortage of assets. And that's been a discussion that's come up again and again and again over the last several weeks. And a question I keep asking in response, Troy, is whether the conditions that have led to that imbalance persist beyond this quarter and through the rest of this year. Do they?
Well, look, I think they probably will, right? Because right now we have roughly 28% more money supply, close to $4 trillion more now than we did at the end of 2019. And you think about how corporates in particular took advantage of lower rates to really bolster their balance sheets and raise a tremendous amount of cash. So there's a lot less need from corporate America and others to raise cash through commercial paper or short-dated debt issuance because they're so cash flush. And then, if you look at the consumer as well, you have 1.6, 1.5 trillion more in savings. You also have 3 trillion more in commercial bank deposits than you did. So the world's awash in liquidity. And so when you're awash in liquidity, you don't need to issue short-dated debt to nearly the same extent as you did in the past. So we do expect the supply-demand dynamic to persist. And what that means, of course, is that we're going to have even steeper yield curves than we would without.
So I'm trying to understand, Bob, what's the most powerful factor here for risk assets? Is it the dynamic at the long end, higher yields, or the dynamic at the short end with an elephant sitting on top of it and this supply-demand imbalance that just has a bias towards lower yields and maybe even negative at some point in the next several months? What's the most important factor at play here?
It's the front end for sure, as long as monetary and fiscal policy stay accommodative. If for whatever reason on the monetary side or the fiscal side, they have reason to pause and rethink the accommodation they're supplying, that's when I think you see the greatest risk. That's when the long end of the market's right.
Do you agree, Subadra?
Absolutely. I think that, steeper yield curves up to a certain extent are good for certain sectors of the economy like financials. But broadly speaking, I think you're going to start, the risky asset complex in general is going to start worrying when real yields start to rise. And that could happen very, very quickly. And at that time is when you're going to see this sort of potential for a sharp correction in risky assets.
We'll talk about those risky assets next on the programme. Guys, you'll be sticking with us. Up next on the programme, the auction block. Investors piling into February's riskiest debt offerings. That conversation up next. From New York, this is Bloomberg. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off right here in the United States. As yields rise at the long end, yields are pegged at the front end. The Treasury selling bills at their lowest levels since March 2020. In corporates, several high-grade borrowers selling floating rate debt, capitalizing on worries about rising interest rates. And in the junk bond market, persistent demand in a quiet week, helping Avis cut last year's borrowing costs in half. Back with us, the panel. Subadra Rajappa, JPMorgan's Bob Michele, and Troy Gayeski of SkyBridge Capital. Bob, I want to start with you, sir. Your words, your quote, I'll read them for our audience. Some want to wait until there is a meaningful correction. I keep telling them that everyone on the planet is waiting for that to happen. Valuations now occupy everyone's time and effort. Nobody likes them here, but that's the reality. So, Bob, let me ask you, Do valuations in this environment just not matter?
To some extent they do, but to a larger extent, they shouldn't occupy all your thinking. If I think of high yield as the perfect example, the yield on the high yield market is 4.7%. It's hardly anything but high yield, at least what we used to know it as, but there's a very different dynamic in place. If we look at credit spreads, for example, they're still about 340 basis points over. If you go back to 2007, credit spreads were 240 basis points over. So there's about 100 basis points of credit tightening that could still happen in high yield, even though we don't like where current yields are. I think that could absorb a lot of the rise in government bond yields as that market continues to normalize.
We're at 320 right now. Troy, do you think we could go another 100 basis points tighter from here?
Well, yeah, anything's possible, but like your other guest said, it's going to be because yields are going up, right? Which means you don't really get much price appreciation. And even though, I mean, look, corporate defaults have been so much lower than anyone feared, even 6 months ago, let alone March. So you're not going to lose too much of that yield from, defaults and realized losses. But you're just getting paid so little. So like we've been saying for 3, 6, 9 months now, after the quick rebound of high yield in Q2 of last year, if you're going to take corporate risk, just go long equities. At least you have meaningful upside. And make no mistake, right? If yields rise enough, that spread compression could be overwhelmed by higher yields. We don't expect it, but it's just a really poor risk reward right now.
Oh, you mentioned the move. I brought up Avis just briefly. We can take a look at that. 11% 9 months ago, $500 million of secured debt. Now the yield is half of that on $500 million of unsecured debt. And Subadra, whenever I catch up with anyone right now, we're not talking about credit risk. We're talking almost exclusively about duration risk, interest rate risk. Is that the dominant risk for you, Subadra?
Absolutely. I think that returns in the fixed income market are going to be negative. I mean, we're coming from historically low yield levels, and I think there's not a single strategist or economist on the street that wasn't expecting negative returns in treasuries for this year. So I think duration is going to be the biggest component. Really, the key risk is that there's just too much cash in the system. Like you just pointed out earlier on, treasury bills, yields were at the lowest level at the auction. So people are going further and further out the risk spectrum to try to invest. And that's why there's a potential that you could continue to see spreads compress as the money finds its way into the risk spectrum.
So, Bob, if duration is the risk, I sense most people would have a bias towards high yield over investment grade. And as a high yield portfolio manager messaged me earlier this morning and basically asked, I think we need a rebrand here. It's not about high yield. Can't call it junk. Do we just call it the short duration asset class right now? Is that what it is, Bob?
John, I'm almost ashamed to admit this, but last night I did an internal call with our top salespeople and our head of equities, Paul Quincy. And at the end, we were asked what our best idea was. My best idea was non-US small cap value equities. And I stepped back, and I'm a bond guy, right? What am I messing around in equities for? But you see the tremendous amount of monetary and fiscal stimulus. You see what the central bankers are telling you. They're just going to let it play out. And this is going to generate enormous growth, a lot of cash in the system. Maybe you felt good selling some assets, raising some cash at a profit. What do you do next? What do you do next week? You put it back in the market. And I think that's the kind of environment we're in. So yeah, in the bond market, if you can find things that will protect you because of the credit spread, it could be high yield corporates, it could be high yield emerging market debt sovereigns that can absorb some backup in yield, a moderate one, then I think you're okay.
This is like fixed income therapy. So let's take a deep breath and I'll ask you how you feel, Bob. How did it feel when you had to sit on an internal call and say, I'm the bond guy, I like small caps over in Europe?
Most of the people on the screen look like they were about to fall off of it.
Troy, what do you say to that? That you're in fixed income and you're no longer looking at fixed income, you're not looking at the bond market, you're looking at equities. And you said equities yourself about 10 minutes ago, Troy.
Yeah. Well, look. So I would say there still are opportunities in fixed income, just non-vanilla, right? If you look at U.S. structured credit right now, whether it's RMBS or even CLOs, right, which have come back a lot, but they are floating rate, and you're starting with a 5.5% to 6% coupon. And maybe if LIBOR goes up at some point in 2022 or 2023, you'll benefit from that. So there are opportunities off the run to make high single digits or low teens, and even more if you get further spread compression. But in general, if you're a fixed income, you can only focus on fixed income, and you can't go after equities, or you can't go after things like Bitcoin, or you can't go after distressed credit, which is being greatly helped by the new issuance, right? So many of these distressed companies are able to refinance, and that's leading to much better returns than we thought 3, 4, 5 months ago. If you can't go after that stuff, it's going to be really hard to have a well above risk-free return in an environment like this.
We've seen a ton of demand for floating rate over the last couple of weeks as well. A lot of people started to move into that trade. Subadra, I want to give you the final word. You've heard two peers of yours talking about looking elsewhere to the equity market away from fixed income. When you look at Treasury yields and start to think about, OK, when do we start to compete for capital elsewhere? You mentioned this. When does the move in yield start to hit risk assets? If it's not 135, if it's not 2 130s, where do you think it might be?
So at some point, I think you're going to see foreign demand come in. It's just not when the market's this volatile. If you look at the last few months of tick data, you're seeing consistent selling coming from foreign investors, both China as well as other and Japanese investors as well. What they're doing is allocating away into assets that have higher yield. At some point, when yield stabilize, perhaps to a range, Treasury is going to look very attractive for foreign investors, and I think that's going to be a backstop for Treasuries when yields rise, because yields everywhere else in the world are very, very low, and it only makes sense for them to buy Treasuries on a currency-adjusted basis.
Subadra, sticking with us alongside Troy and Bob. Coming up on the programme, up next, the week ahead, the final spread featuring Fed Chair Jay Powell testifying on Capitol Hill. That conversation just around the corner. From New York City, this is Bloomberg. From New York City, this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up next week, you will hear from the Treasury Secretary Janet Yellen discussing the economy on Monday, then a ton of Fed speak through the week. Fed Chair Jay Powell testifying before Congress on Tuesday and Wednesday. G20 finance ministers meeting on Friday, and the House of Representatives planning to vote on President Biden's fiscal stimulus package. Back with us, SocGen Subadra Rajappa, JPMorgan's Bob Michele, and Troy Gayeski of SkyBridge Capital. Subadra, let's go straight to that testimony with Chairman Powell next week. What are you looking for?
More of the same. I think that the Fed consistently, if there's ever been a time when there's been unanimity between all of the different governors and Fed presidents, it's now. They all seem to be singing the same tune. So I think that they're going to be focused on employment. I think they're going to be focused on inflation. And they're not going to really be focused on sort of transient moves in the stock market or the sort of sell-off we've seen in the bond market. So their focus is going to be fair and square on employment and inflation.
I sense, Bob, you think there might be a subtle shift.
Yeah, I want to hear from the Fed how much inflation is too high for too long for them to view it as transitory. And what might that mean? Might that mean tapering the balance sheet sooner than the market expects? Before we were on, we heard Larry Summers talk about raising rates much sooner than anyone anticipated. So that's one thing I want to hear. The other thing I want to hear about broad and inclusive maximum employment. What does that mean? How do they intend to achieve that with monetary policy?
Let's build on those 2 points separately. Troy, let's start with the CPI point. This is a Fed that's telling us what will happen with inflation. And we all understand that. The four of us can agree on it. The base effects kick in the next couple of months. CPI shoots higher. They're telling us what they'll do as well, that they'll sit it out. But to Bob's point, people keep asking the same question again and again and again, Troy. For how long can you sit there and say it's transitory?
Well, look, next week, that's what they're going to say. I mean, remember the days when Powell was considered a hawk, right? Seems like eons ago, right?
Yep.
For the time being, they're looking through it, and they're going to look through it as long as they can, because they just don't care about financial stability risks anymore. Now, to your point, we talked about this earlier. or you mentioned it with Bob, is the next risk for markets is when they start talking about tapering, right? And remember, they'll announce a taper long before they actually taper. We still think the soonest you could see that is Q4 of this year, and it might still even be Q1 of next year. And the other thing to remember is talking about tapering and actually reducing the pace of money supply increase are two different things. You'll get a risk off, but eventually you'll rebound. It's when they really start to drain liquidity, which again, Q2, Q3 of 2022 is the soonest one could see that. That's when there'll be more problems for all assets. I mean, every asset's going to deflate in value. It's just a question of how much. And a lot of that will be a function of how overextended we are and just how robust growth is going to be the back half of this year and in early 2022.
Well, you all remember the line from 2013 from Chairman Bernanke that tapering is not tightening. I imagine we'll hear that a whole lot more later this year as well. Subadra,
over and over
on
again,
repeat,
John.
Troy, on repeat. The first point Bob made was the social warrior point as well, Subadra. I just wonder how much has actually changed the Fed. Now they are worried about things like wealth inequality. That's not just PR. That's got to matter to policy.
I think that's going to take time, right? It's more of a longer term mandate. It's not something that they can do anything right now, but they're going to continue to be focused on equality and sort of moving away from what is observably a K-shaped recovery during the pandemic. The question is, what can they do tangibly over the near term? Probably nothing. So they're just going to try to be focused more on these broad issues over the longer run. It's not going to have any near-term impact on the markets.
Okay, guys, I've got to squeeze in the rapid-fire round. Do you know how this works? 3 quick questions, 3 quick answers. First question to you: have we seen the low on the 10-year yield this year already? Yes or no, Bob?
Yes.
Troy?
Yes.
Subadra?
Yes.
To credit, have we seen the tights on high yield yet for the year? Troy?
No.
Subadra?
Perhaps.
Bob?
Not even close.
Final question, Chairman Powell, tune in or take an early lunch? Tune in or take an early lunch next week. Subadra?
Early lunch.
Bob?
Tune in if Larry Summers is on the guest panel speaking.
Yeah, there we go. Troy?
Take an early lunch.
Hey, guys, great to catch up. Appreciate your time. Good to have the team back. Subadra Rajappa, Bob Michael, Troy Gayeski, thank you. From New York City, that does it for us. We'll see you next Friday at 1 p.m. New York time, 6 p.m. in London.